Everyone knows what's the difference between a pre-qualification and an approval. Want to know the steps that it takes to actually be approved for a loan? Stick here. We'll be right back with that information. Dr. Adrian A. Gentry, aka Dr. Real Estate Jacks. I'm here again. Willie has come to grace our presence with more mortgage knowledge. Willie Smith, tell them a little bit about yourself.
Willie Smith, Hamilton Group Funding. Been in mortgage banking for 20 years plus now. I am happy to be able to be on another episode here with Dr. Adrian, and let's get right into it. You guys buckle in, and preferably we can learn a little bit today.
All right, so now everybody wants to get qualified for a mortgage. They don't really understand it. I'm gonna be honest with you, so much misinformation out there about what it takes to get qualified for a mortgage. So what we want to do is kind of dispel a lot of those myths today and educate you on the right way. So one, people come all the time with a pre-qualification letter and others with an approval letter. Could you tell us what the difference between the two are?
Well, the biggest difference is a pre-qualification letter typically isn't even worth the paper that it's printed on. Most of the time, a pre-qualification letter is where the client went in, gave a lot of verbal information, or maybe even went online and just filled out, a form, and it just spit out a letter saying, hey, you've been pre-qualified for this amount. A pre-approval letter is when the lender actually did a really deep dive into reviewing your finances. As we may have talked about on other episodes, we're going to look at your income, your employment, your assets, your credit. If a lender has not asked you those questions and also validated your answers to make sure that those things are accurate and everything is acceptable, you have not been thoroughly pre-approved. And the pre-approval is what you want, because you don't want to go out there and start looking for a home, find the home that you really like, to come back and find out that you really can't get your loan.
Gotcha.
So if you can get the pre-qualification letter, sometimes that's fast and it's kind of that microwave approach and you're getting a little bit more immediate satisfaction.
Right.
But then you're setting yourself up for down the road, you may have a problem. Versus when you go the route of the pre-approval, everything is validated up front, and you can have some confidence and some peace of mind when you go out there and start looking for the home, because you know that your financing is in place.
Right. So every time, and it's funny, every time that I talk to a potential buyer and I send them your information, the first thing I say is, Willie don't play. First of all, he's not going to give you that pre-qual. He's going to dive deep, and it may take a week or two to really dive deep and find out what you're actually qualified for, and have that approval letter in hand, versus going out, like you said, you're shopping for something, but you're not really approved for the loan.
That's right. That's right.
So now I sent everybody over to Willie, right? We're not looking for pre-quals. Everybody get those in the mail all the time for credit cards.
That's right. That's right.
We're looking for an approval.
That's right.
When I send them over to you, what docs do they need to pre-qualify?
So right off of the bat, it's going to be certain things that we're going to need almost every time, right? So we're going to need pay stubs covering the last 30 days. We're going to need bank statements covering the last 60 days, okay? We are going to need W-2 forms covering the last 2 years.
Wow.
We're going to need a copy of your driver's license. We're going to need a copy of your ID. Those are just the basic documents that we need in order to get started for us to be able to determine, are you eligible for a mortgage and what mortgage you may qualify for. So if you go out there and you've spoken to a lender and you have not at least provided those minimum documents for them to be able to look at your credit, look at your income, look at your employment, look at your assets, and also validate it, that means that you have not been pre-approved, you've only been pre-qualified, and you could be opening yourself up for a journey that may be a little sticky.
Gotcha. And the worst thing you could possibly do, and on the real estate side for us as real estate agents, is get to the table. We put a bid on the house. We win. We put an offer in on the house. We win that offer, and then at the closing table 20, 30 days later we can't get you qualified.
That's right. That's right.
And it's a sick feeling, not just for the real estate agent, but the buyer, but the seller, and of course the buyer.
That's right.
So we want to make sure that everyone understands there's a grave difference between the two.
That's
so you're
right.
saying I'm pulling credit.
That's right. That's right. That's right.
What credit scores are you looking at? Do you pull from all three?
Yes, yes. So what we're going to do is you'll get what's called a tri-merge credit report.
Okay.
Tri-merge credit report, which means we're pulling a report from Experian, Equifax, and TransUnion.
Okay.
So all three of the credit bureaus, we're going to pull the credit report from.
Okay.
Now what we do is when we pull a tri-merge, we throw out the high score, we throw out the low score, and your middle score is your representative score. Okay. Now, it's not an average. It's throwing out the high, throwing out the low, using the middle.
Right.
So, just for a quick example, if you have a 660, a 640, and a 620, we're going to throw out the 660.
Okay.
We're going to throw out the 620, and we're going to use that middle score of a 640. That is your representative score with the bank.
Gotcha. Now, if a buyer is qualifying with their spouse, see, so we gotta make sure.
Yes.
If you're qualifying for a loan with another person,
right?
How do you grade the scores at that point?
So you're getting a little fancy, okay? So when that happens, it's the same process, but it's a little bit of a little twist that the bank throws in there.
Okay.
So let's use that same example. You're going to have two buyers in this particular case. Both of them, we're going to pull scores from all three of the bureaus. Both of them, we're going to throw out the high score and throw out the low score and use the middle score. Then when we have both of their middle scores there, we're going to take the lower of the two middle scores.
Okay.
So if one person's middle score is a 640 and another person's middle score is a 635, we're going to use the 635 score.
Okay, because you hear a lot of people sometimes like, I have the credit.
Right.
Well, I have the credit, but I don't have the money.
That's right.
They got the money, but they don't have the credit.
That's right. That's right. So in a case like that, we can only use the person's money who's on the loan, and we're also using their credit.
Gotcha.
So if it's a situation where one person has the money and they don't have the credit, well then unfortunately that person is not going to be on the loan until they get the credit.
Gotcha.
Because both people have to meet the minimum credit score requirement in order to move forward on the loan.
Gotcha. So, big thing, collections, right? Tell us the guidelines behind collections, because I've talked to a lot of buyers and they say, well, I have some things in collections, right? I need to pay all of that off first. Now, do you advise to pay off all the collections, or how do you look at collections on credit scores?
You know what? That question is a great question. But what I would encourage the clients to do is, before you pay off anything, talk to a mortgage professional first.
Gotcha.
Because there's many times that this plays out for me, probably 6, 7, 8 times a week, that clients end up spending months and thousands of dollars on collections accounts that may not have any bearing on your ability to get approved.
Wow.
Especially some of the older stuff. Right. I've had clients, we're in 2020, I have clients going back dealing with stuff in 2014 and 2016. Many times we're not even paying any attention to those items. So what I would advise you to do, especially since there's so many, old student loan collections, old medical bills, old credit cards, old just different things, talk to a mortgage professional first to find out what credit collections are really affecting your ability to get the loan, and what credit collections that are on there that may be derogatory, but they're maybe not necessarily something that you need to go and pay off and go and deal with. Right. Because it's better for you to get validation from that professional.
Correct.
Versus going out there and just doing it on your own and kind of going with your understanding
of credit,
because you could end up making a mistake and spending thousands of dollars
right.
that you didn't need to spend.
Absolutely. And then you have some collections that have been on there for 5 years.
Right.
Paying them only brings them to the forefront.
That's right. That's right.
So it damages your credit more than it actually helps your credit.
That's right.
So please, like you said, talk to someone first. Please don't try to do this thing all alone. Talk to someone.
Do not spend a single nickel on paying anything on your credit report until you've spoken with a mortgage professional who can advise you and give you a clear game plan on what you can do. And I cannot stress enough how many times on a weekly basis that I've talked to people that have literally spent so much time doing what they thought they were doing to fix it for them. And it's logical. Like, if we're going to be if we're going to be truthful about it, most people say, hey, I want to go buy a house. Well, the first thing I'm going to do is let me get my credit straight. And it's logical to say, okay, let me get my credit report and then I'm going to just start paying stuff off. How could that be bad? It could be the worst thing that you could possibly do.
And please understand, it is a hard inquiry.
That's right.
When you're going for a mortgage.
That's right.
And also look out because you'll receive phone calls because people are trying to buy those leads.
Right. That's right.
Trigger leads.
Right.
So don't let everyone pull your credit.
That's right.
But have someone, and it's only 2 or 3 points for one hard inquiry.
Right.
So please have someone pull your credit that can advise you on what you really need to do. Now, I'm a self-employed person. Do you qualify me based off of the same things that you qualify an employee, a W-2 employee?
Totally different. So if you're self-employed or someone who's on 1099 income, we're going to look at the last 2 years tax returns, and then we're going to also want to see that year that we're in year-to-date profit and loss statement.
Gotcha.
So for instance, we're in 2020 right now of this video. So we're going to want to see your 2018 taxes, your 2019 taxes, and then we're going to want to see your 2020 year-to-date income.
P&L.
So it's a situation when you're self-employed, it's not a problem. We're going to do a loan for a self-employed person just like we would with someone who's a W-2. The issue is that if you are a a self-employed person, just like when we went to the neat things that we needed for a W-2 person, and one of the things was 2 years worth of W-2 forms. What that's doing is it's establishing history. So if we do a self-employed person, we still need to establish history. So that's why we want to see 2 years worth of tax returns.
Absolutely.
We want to be able to see that the business that you have opened or the line of work that you're in or the trade where you may be getting 1099 income, that income is consistent. Okay. Now, the other thing with self-employment is we're doing your qualification based off of your net income, not your gross income.
It's going to take some planning.
That's right. So, for example, let's just say you're a truck driver and you made $100,000 last year, but you wrote off $80,000 and showed the IRS that you only made $20,000 just to keep your tax liabilities low. And there's nothing wrong with that. It's the American way. Make as much income as you can, get as many deductions as you can to lower your tax expense.
Right.
It's smart, but understand that net income is what we're using to qualify you with.
Right.
So if you write off too much and don't show sufficient income to be able to support the loan request, it could put you in a sticky situation when you're self-employed. So it's about planning.
Correct.
So you may want to get with your accountant or your tax person and kind of get in preparation of, hey, I want to buy a house. Make sure that your strategies are in place with how you're filing your taxes to make sure that you're showing and documenting sufficient income for your loan request.
Absolutely. And $20,000 in Jacksonville, Florida, you get a hut. That's all you're getting is a hut. Please plan. Okay. So, how long does that? Okay, so I went through. I've given you all my documents. You've reviewed them. You've looked at my credit. You've advised me on what I need to do. You've approved me. How long does that approval last?
Okay, good. So the pre-approval doesn't go away. What happens is that the documents that we base the approval on can begin to expire.
Gotcha.
So once I pull credit, that credit report is typically good from 90 to 120 days.
Okay.
So once we get to day 90 or 120, depending on the loan product, we don't have to start over. I may just have to update your credit report.
Okay.
Same thing with pay stubs or bank statements. If I pre-approve you and now all of a sudden it's 90 days and you still haven't found that perfect home yet, you don't have to start over. Now you may have to just update W-2s, update pay stubs or update bank statements just to make sure that we have the most up-to-date and accurate information for you.
Gotcha.
So the pre-approval doesn't go away. It's just some of the pieces that we use to pre-approve you may become stale dated and we need to update them so that we keep everything fresh. So when you do find that property, which you will, everything's ready to go.
Gotcha. And I'm gonna put this in as a real estate agent. Do not. I'm gonna say it again. I need y'all to get it. Do not go buy anything after you've been approved. I don't care if it's popsicle sticks finance. Do not buy anything once you're pre-approved for a loan, because they have to go back and they look at these documentations before closing. And if now they see you've bought a car, if you financed a boat, it could damage your DTI ratio. And we talked about that in other videos. Do not go buy anything until you're in that house. I don't care what it is.
That's right.
Do not go buy, because we see it all the time.
That's right.
Where people actually qualify, they're approved for a mortgage, and then all of a sudden they believe that their credit score is now 706. They should get a brand new Jaguar.
Right, that's right. Or go buy the furniture for the house.
Right.
Wait until you have the house, then go and get that furniture.
Absolutely.
So we probably can do a whole segment on things of not what not to do.
We can listen. It's like bubble gum shrimp. It's just after the next. Do not go buy anything at all. Okay, so when you approve someone, do you see all the loan products that they qualify for, or no? Go ahead.
Yeah. So we're gonna look at everything.
Okay.
We want to be as thorough as we possibly can to let everybody know what all of their options are.
Gotcha.
What you're eligible for, what you qualify for, and typically I like to give people at least 2 or 3 options. 30-year loan. Some people may prefer a 25 or a 20. Some people may want to do FHA. Some may want to do conventional. So you may have a veteran or active duty who wants to take advantage of their, VA. You may have someone who wants to live out in the sticks and wants to go USDA.
Gotcha.
So we want to be able to give everybody their options so that they can make a decision based off what's best for them and their families.
Gotcha. It's not, and I like to stress this so much. It's not a one size fit all, right? No loan product, no home, no situation, no credit score is a one size fit all. So when you're talking with a Willie or Willie, when you're talking with Willie, make sure that you're giving as much information as possible. Right, so they can help you decide what may be best for you and your family. So a conventional loan may not be the best thing for you, even though your mother received a conventional loan.
Right.
The FHA may not be good for you if you're planning on leaving the property within a year or two. Right, so make sure you give all the information that you possibly can so they can guide you in the right direction and help you find what fits your family.
Right.
Now, got to talk about these words. Okay. Right? I don't even like talking about it. Why? Because I ran up so many of them. It's called student loans. So, when you look at student loans, how do they affect approvals?
Well, I'm still going to go back to when you're sitting down with your mortgage professional, making it based off your particular situation.
Correct.
Because depending on the loan type, it is also going to affect how student loans are, viewed. So, for instance, if you're a veteran or active duty military and your student loans are deferred for at least 12 months, VA doesn't count them at all. If you're doing an FHA loan, whether they're deferred in forbearance or income-based repayment plan, we're always going to count a certain amount into your debt-to-income ratio every time. But then if you do a conventional loan, if you're in an income-based repayment plan, we may be able to count that lower, smaller number. Or we may have to count 1% of the balance, or in some cases we can count 0.5% of the balance. So when the situation is student loans and you have them and you're not sure how they may affect you, the thing that you can do to help yourself is get with a mortgage professional so that you can really find out what your options are. Do not talk yourself out of the loan based on the fact of you thinking that you have too many student loans to be able to get a mortgage.
Love it.
Because it's going to depend.
Love it.
Everybody's situation is case by case. And again, your friend may have $100,000 worth of loan and it stopped her from being able to qualify. But you may have that same $100,000 worth of loan, and maybe you have some eligibilities, or maybe you're a little bit stronger here or there, that it may not prevent you from doing it.
Absolutely.
So again, get with a mortgage professional and make sure that your situation and your student loan situation is reviewed so that you can get your best options. It is not automatically a deal breaker, but it is going to affect you somehow whenever you go through that pre-approval process.
Gotcha. So we got you the documents. You went from pre-qualification to approval, right? Now that you're approved, we've selected a loan product for you. We looked at your debt to income ratio. We see how your student loans, if you have them, have affected you in any shape, form, or fashion. So now we've gotten to this point. We know that your approval will last for up to 120 days. The only thing that has to be changed is updated documentation. Now, what do you tell any one of your buyers to prepare for before buying a home?
Well, the next thing after that is just really, once we get to the point to the pre-approval, I really defer them to their real estate professional.
Gotcha.
In this case, now it's time, lights on action for you.
Gotcha.
Because we would have already went through that pre-approval and determined also what the budget is. We would have talked about the financing. You and I would have talked about how we need to structure the contract. Do we need closing cost assistance? Are they getting down payment assistance? Are they looking for an income producing property? Are they looking for a townhouse? Hey, they don't want HOA fees, whatever. Once we get to that pre-approval process and hey, you've been approved for $250,000. This is the loan type. These are what the terms are going to be. From there, now it's a matter of deferring to the real estate professional to make sure that now they're finding something that's within that budget.
Gotcha.
And we try to avoid the surprises because we would have already talked about, okay, your budget. You already know what your mortgage payment is going to be if you go up to your maximum pre-approval amount.
Right.
So now when you're out there on Saturday or Sunday looking for a home and you see something that's in your price range, you already know what your payment is. It's not a matter of, hey, can I really afford this? So the pre-approval really is the heavy lifting.
Right.
Once you get that done, now the fun the part comes in. Now you can start talking about, bedrooms and bathrooms and backyards and bay windows. You can start being able to, enjoy the process. But in the beginning with that pre-approval, it's the grind part.
Absolutely.
And then once you get past that, now it's the fun part because you get to go shopping and I just mention all the time, lean on your real estate professional's expertise. Once you get your pre-approval amount and you set the criteria, let them work for you to get you what you really need and what you really want and what really works for your family.
And I have to go back to the part of we've already spoken about that. And I like to let people know this right here. If you have a mortgage professional loan officer that is not looking at your best interest, right? Now they can qualify you for its max. For the max, right? You can qualify for $300,000 and be house poor. But if they're not looking at your best interest, and they're not saying, you know what, you qualify for $300,000, but you really need to stay around $270,000 to really run your household effectively, you're dealing with the wrong mortgage professional because they should care about your finances, not just closing out a new loan.
That's right.
That's what I love about. I heard it nothing but great things before I even met Willie about how he had the utmost integrity. He cared about the people who he was giving loans to. So I have to let them know that please have a loan officer that cares about your particular needs. Just because it says $300,000, $200,000 doesn't always mean you need to spend $200,000. And if you've been completely vulnerable, open to your mortgage professional and giving them that information, guess what? They're going to advise you to do the right thing by that money.
Right.
Now, last one, right? And I think this is paramount, right? Because pre-approval, like we talked about, and pre-qualifications are two different things. So I have the idea in my mind right now. I'm the buyer and I want to buy a house. How soon should I start the qualifying process? How far out should I start the qualifying process?
My recommendation, and it's just really an opinion of mine, I think that it's kind of case by case. If you feel that your credit may be a little sticky, I recommend you start at least a year ahead of time.
Gotcha.
At minimum. If you feel like your credit is pretty solid, I still say start at least about 6 months.
Gotcha.
You do not want to get down to the wire because it's just so many different things that need to be reviewed. And it's just a lot of steps from the point of starting to the point of getting that pre-approval or even finding your home and closing on the home.
Right.
So again, if you have any doubt that you're a little sticky, 12 months, solid, at least 6 months, because we would rather get everything done than be waiting, than to get down closer to the finish line and put stress on the process just because we got started too late.
Absolutely.
And depending on what market we're in at any given time, things, you have to be prepared.
Absolutely.
When you're going in to putting these offers, these sellers, they want to know that your stuff is ready and you're ready to go.
Absolutely.
So again, you can take some of the pressure off of yourself by getting started early, so that you can have all of your ducks in a row, everything lined up, budget, strong pre-approval letter, everything, and now I'm just kind of waiting for my time to get here, and then you can shoot out from there.
Gotcha. And then in the meantime, we tell at the latest, especially if you're renting, and your lease is going to end at a certain point, we say, look, at the latest 3 months, start that process of getting pre-approved 3 months out, and then we can try to find you a home from there. But a lot of people, they think that one, they may not qualify, or they get the idea in their head today, I want to buy a house. I'm not saying don't start now, but you have to be strategic about this, especially like I was telling, like we talked about in another video, the climate does not allow you to wait around.
Yes.
There is new construction popping up left and right.
That's right.
But there's very little inventory of pre-existing homes, and you have to come in strong.
Yes.
You have to have your ducks in a row to submit your offer. We must have that pre-approval letter in hand. So please step out of your comfort zone. I know a lot of times it gets kind of frustrating when you're talking about pre-approval and giving someone all of my information, and they're going to have my credit score, and what does it look like, how much am I going to get? You will never know until you actually put the information in and you sit through the process of getting pre-approved. So it's a great difference. Pre-approval, pre-qualifications. We've taken you to the entire steps of it. After you found the home, we're going to close it. Willie's going to close you out, and Willie's going to close you out. And it's really, after you get that process done, it's on us, right?
That's right.
It's literally Willie finishing the documents on the loan side, me calling his phone 35 times a week to make sure everything is okay. We're writing offers on the real estate side. We're talking to the seller, we're talking to Willie, we're talking to the title company, and we're trying to get you into that dream house. So, thank you so much for tuning in again. Dr. Adrian A. Gentry, aka drrealestatejacks.com, changing real lives through real estate. And this is Willie Smith with
Hamilton Group Funding, Military Mortgage Pros. Look me up. I'm on Instagram, Facebook, LinkedIn, all the social media outlets. Be happy to help you. Use me as a resource.
Thank you so much. Subscribe, like, share. We'll see you soon on the next video.